Hey, what's going on, Cashflow Hackers? It's Chris, Life 180, and I got Walter Young here with me again. And this video, we're going to talk about the importance of staying power, the importance of having money, whether it's for opportunity, whether it's rainy day. In some of the conversations we've been having, Walter, it's been one of those things where the market goes through cycles. I love your perspective when you're looking at running your life like a business, right? And taking radical accountability and being the CEO of your own life and your own financial world. And one of the things we know, everybody knows, is that the greatest risk to business is running out of money.
Right.
Businesses fail when you run out of money. Right. And obviously there are things like bankruptcy and you know that stuff that comes into play. But like from a basic perspective, let's talk about the importance of having capital set aside, right? Because there's, making big investments and taking risk and trying to get big returns. There's increasing cash flow. There's doing different things strategically in business and in our lives that will do different things. But you used to be a consultant with Deloitte. You've got an MBA. You've been in this world where you've seen this happen time again. You've seen the good, the bad, and the ugly when it comes to companies that have had staying power, not had staying power, had the right reserves, been able to take advantage of opportunity or miss opportunity because they didn't have it. So
yeah, I think
how do we dive into this?
I think you asked the right question, which is why do businesses fail?
Yeah.
And people always tell me, well, because maybe it's bad management, maybe it's a market cycle, and the real answer is they just run out of money.
Yeah.
Right. Because if they had a little more money, they might have gotten through a cycle or changed management or come up with a better product. And the same question we could ask at home, which is why do households fail?
Yeah.
Well, it's because they run out of money also, right?
Yeah.
And yes, there may be health or loss or divorce or some of those
Sure.
factors, but really it comes down to we just didn't have staying power, right? And
Well,
so I like to use the term staying power because it just feels like it just feels a little bit stronger in terms of that's one of the things we want to do.
Yeah.
And staying power comes before the investments, before the growth, right? It's really your first line of defense is being able to get through the potential issues that come through us in life.
So I got to ask you a question on that, right? Like, so this idea of opportunity cost, right? So what do you say to people that say, okay, if the staying power comes before the investment, well, you're missing out on all this chance. The younger you are, the more risk you should take.
Sure.
Right? Like that.
I guess we have to define how much is in your staying power fund or in the emergency fund, right? So if I have like no cash and I'm all invested, right, which is the temptation to do because a lot of times liquidity or it doesn't earn as much.
Yeah.
The reality is that anytime I have a negative consequence, then I have two places I got to go, right? I have to either go into debt, which is not the cycle we want to get into,
right?
Or I have to be able to cash in productive assets, which is also an opportunity loss, right? And so the idea is that this staying power is that buffer between having to go into debt or cashing in more productive assets. So it allows me to function in that range when life doesn't throw isn't as smooth as maybe I would hope it to be.
And to make matters worse, I'd love you to dive into this a little bit. This is like a principle I teach all the time. It's like typically when you go into that spot, if you don't have the emergency fund, if you don't have that staying power fund, so to speak, emergency or opportunity is what I would call it, but the staying power fund, typically when you have to liquidate assets to survive, because that's where you're having to dip into, it's during economically challenging times where those assets are lower. I mean, it doesn't have to be. But for the majority of people, that's going to be the case. And so what you've done there is now, if the market goes down 20%, now you're dipping into negatively performing assets. You're getting less of the value. You're now having to start back from nothing. And I think this is a cycle that we've seen. And I believe this is one of the reasons that Americans are struggling is because if we work for 40 years, I look at it in different chapters, right? And if we have, we know that we have these boom bust cycles, right? And I don't know how much, we haven't talked about how much you are into that whole philosophy and theory or whatever. But I really subscribe to the boom bust cycle kind of theory because it's just human nature and demographically driven and all these things. And we know that, every 8 to 12 years, there's going to be a boom bust cycle. And the bust cycle is not anything catastrophic. It's not like doomsday like a lot of people want to make it out to be in the middle of it. It's just part of a cycle, right? And so if we know that these are going to happen and they've always happened predictably, why are we not planning on them? Why are we not preparing for them, at least for our own protection, even if you don't want to look at it opportunistically? And so you know, how do you kind of bank on that? How do you plan on that?
I don't think the United States is a saving culture in general, right? If we look around at other cultures around the world, they have maybe twice the savings rates that the U.S. does, right? And they believe in having that buffer, that savings ability, because they may not have the same credit facilities and things that they can access that we can. Like we can go right to a credit card, you know, and you know, and get into some of those things, right? Which
they can't sell their debt away to the rest of the
same,
world. Like we
do. So they may not have the same facilities, and we just don't have that culture. And I also think people feel that if I have money in a savings environment, you know, whatever that vehicle might be, that it doesn't have the same earnings capacity that if I invest it. And that's true. But the reality is that it just takes one thing to go wrong. And what you're talking about happens. I sell assets at the wrong time. I may have a tax consequence to do so, or I have to go into debt. Now I'm paying 18%, and you know, where I could have just maybe. So it really helps just get us through, because life. An old advisor told me that life is just a series of planned and unplanned events.
That's a good point.
So when we have something that's unplanned, how do I deal with it? And what we really want to understand is what is the least costly way of handling that. And we're not all going to get through this unscathed, right? So having whatever the level of buffer that makes sense for you, I think is really critically important.
And it's why I always say financial structure is more important than like the assets that you have and the rate of return you're getting and so on and so forth. Because if we have a 40-year time window that we really have productive years to be able to earn and save and invest and all these things. Well, if let's say we go through one of those cycles, 10 years, and you feel like you're doing really well, and you've put money in your 401k, you've put money in a Roth, you've saved like all these things, and then bang, we have a down cycle. Your account value does a 2008 where you go down 30%, you lose your job for a year, 18 months, something like that. Now you're starting over. Everybody, I feel like we've lost sight that that's actually a possibility.
Yeah, it can be ruinous.
And more likely than just a possibility, at some point in time over the next 20, 30 years, it's almost inevitable that something of that nature is going to happen again. We don't know how, we don't know why, we don't, and it doesn't mean it's going to be the end of our economy like a lot of people want to make it out to be, like the end of the dollar, the end of the US. But it just means there's a cyclical nature to all these things.
Yeah, there's obviously large booms and busts, but also I would say there's lots of micro ones in your life.
Totally.
And they're cumulative in nature.
Yeah.
And so one of the things that we forget about is just the good old-fashioned compounding curve.
Yeah.
If I'm investing money in my 401k or investments, and I just get that 8 to 10% investment growth, you know, it's years, but eventually I get that rocket ship phase, right? But every time I have one of those little micro events where I have to take away, I lose the ability to really get to where I could have been.
Compounding.
And so that staying power is what allows those assets to stay invested through the good and the bad, right? And so that's, I think, really the value of that, is understanding that savings and investing are two separate things.
So back in the day, I think it was like 2014, 2015, when I first started like really getting into the content game, I did this research, and I remember coming across this article. I'll see if I can find the reference to it, because I'm sure I have it in my Google Drive somewhere. But it showed that in 2008, I mean, how many businesses failed? Like so many businesses failed, right? But there was a stat that it was like 70% of the businesses that failed, that like closed, it got absorbed, whatever, were actually profitable. And the reason that they failed was because they didn't have the staying power.
They ran out of money.
They ran out of money.
Yeah.
So you can have a profitable business.
That's right.
But if you run out of money, it doesn't mean anything.
And at the home level,
that's huge.
I think that's the same at the home level, which is generally, if we're doing a good job, we're saving some money along the way. We're profitable in our own nature.
Totally.
And it doesn't take much for us to suddenly have a year or two where that gets interrupted. And so the question is
6 months to 8 months for a lot of families.
Am I out of the game?
Yeah.
Or do I have the ability to withstand it and still then jump back in as things improve? Because they will. And remember also in that 2008 downturn, HELOCs were frozen. So a lot of access to liquidity was gone.
That people were relying on.
Right. That people were relying on.
Their safety net.
Right. And so having that source of staying power, that's immune
Guaranteed.
From some of that, right? And there's lots of different vehicles that can do that, right?
Yeah.
There's lots of vehicles that help us with that.
Yeah.
It doesn't have to be an old-fashioned savings account, right? There's other options that we have.
Totally.
But I think just being able to make sure that we know that there are the big busts that we have to worry about, but all those little micro ones add up over time.
Yeah.
Where we're not as successful as we could have been because we're cashing in, paying a little extra interest and debt here and there that maybe a more robust liquidity strategy could have helped us with.
And that's the importance of structure and allocation and getting beyond the conversation of just what's your rate of return. And it makes no sense to put money in this account over here that's going to get half the rate of return of this account over there. They solve different problems, right? And it's like this account can get a better rate of return, but if it's not helping you solve a problem or build in protection against a downturn, well, it might get a worse return in the safer account this year.
Right.
But what's the value of that return and having access to that money in a down market 6 years from now, 7 years from now, 3 years from now, whatever it is?
I think a very silly, stupid analogy could be if you think about a football team.
Yeah.
Right. You could have the greatest quarterback, but you have no offensive line.
Yeah.
Who cares, right? I mean, he has all the potential to win all these games, but if you don't have someone that can protect him,
surround him with talent.
Who cares, right? So, or it's the old analogy of a castle and moat, right? So, so we just have to make sure that we understand that life is, life will throw some curveballs at us, and our ability to survive those is going to dictate how will we come out on the other side, right? Will we be washed out and become one of those statistics, or do we get through it and have the real staying power that we talk about?
So at the end of the day, the principle here, it really just comes down to running your life like a business, right?
It's right out of the business world, right? That liquidity, the companies get some other options that individuals don't, right? But lines of credits and the ability to access market is so critical.
Totally.
That cash on hand, is an important metric for businesses to make sure they understand how fast they're burning through that cash, right? We know cash is king for a reason, right? We've got to have access to it in the good years and also in the bad years. And we haven't really done I don't think, justice the idea that if we have a long prosperous period, that now can become an opportunity fund too.
Yeah.
Right. So we think of it always as in the negative term of getting through disasters, but the reality is that if we're well heeled, when those downturns happen, we might be able to take advantage of them. Right. We're not going down with the ship. We're actually looking around, seeing what are the distressed assets that I might be able to participate in because I had the forewithal and the forethought to plan for that.
I'll give a story. So in 2008, I have a really good buddy from high school whose dad ran an HVAC company, right? Small company, but really conservative dude, right? And so dad, by the time I was 28 in 2008, right? So my buddy, his name is Jason. So Jason was getting to that time, and 2008 happened, and everything got horrible, right? Businesses were struggling, but because his dad had been so conservative, Jason was just about hitting that place where he's taking over the business, right? Dad wanted to retire, doing a buyout to his son, that kind of deal. But they had so much capital, like just stashed away. They had savings accounts, right? Like at this time. And when the economy went down, I mentioned 70% of businesses that failed were profitable. They went in and they were able to buy out 3 of their competitors. And
Great
2
example.
of the competitors were bigger than them. They were able to buy them out for pennies on the dollar, like 30 cents on the dollar compared to what they were valued. And they were able to then expand. And then now they have literally the largest HVAC company in the whole area.
Yeah. How many times you talk to someone who is, in the investment world or something, and they're just like, the markets are down 10%, maybe something modest even. And they all talk about, I really wish I had money to invest because that's the opportunities. Well, I can't sell an asset to go buy another asset, right? I have to have some liquidity around to be able to take advantage of some of those dips, and they happen, frequently.
It's like everybody likes to talk about the carnage that happened in 2008, but what people don't talk about, and they should talk about more often, is the fact that more millionaires were created in that time frame than any other time in history at that point, right?
Makes sense.
And so it's like if you were prepared and had the liquidity and the access to capital, you won huge.
Right. Think about the tech companies today and the billions of dollars that sit in cash. They're not there to protect the company as much as they're there for the opportunities.
Look at Warren Buffett. Like, what did I just saw he moved like $60 billion into cash, or some crazy number. Like, I don't know, don't quote me on that number, but it was a monstrous number.
They're looking for the merger of the company, the upcoming idea that they could buy. Right. And if they don't have the liquidity, they can't do that. And so sometimes they get punished for having too much cash. But the reality is they're looking for that opportunity, right? And they're not gonna liquidate dilute their stock to buy something. They have the cash for it.
But let's talk about that, because you say they get punished for having too much cash. I mean, there's a little bit, you might make a little less money, but the punishment for having too little cash is not nearly the punishment for having not enough.
Or missing the opportunity for a better acquisition of some kind.
For sure.
Yeah, and I think at the home level, we just have to understand there's a balance. And everyone has their own balance. You've talked about, if you lose a job, how long it takes, how many months it takes to get one. And I think lots of times we're probably underfunded in that liquidity department because we just throw the dice and just see what happens. And mostly we're okay, but I think people sleep better at night when they have that liquidity available to them.
I think for me, the way I look at it is it's the consequences, right? And I'm a poker player, right? So I'm always looking at things through the lens of asymmetric risk, right? Like I'll play a tournament, I'll spend $1,000 on a poker tournament, right? And I know that there's only a 20% chance I'm going to cash, right? And I realize that even if I cash, there's the chances of like I'll double my money maybe. So that sounds negative, but if I have one good hit out of 50 tournaments, I'm going to 100x my money, right? And so you have to have the bankroll, the liquid reserves to manage that flow, right? And the challenge is most people are not prepared for that. Most poker players fail because they run out of money, right? And what happens is they just mismanage all that and they take on too much risk when they can't, and then before you know it, they're out of money. In households, it's the same thing. I look at it in this nature as if you don't have that prepared enough, you might be doing well for 15 years, but it takes one instance.
That's all it takes.
And everything that you have that you've worked for 15 years could be gone. And if you do that and you're not prepared, now all of a sudden a 40-year time frame gets cut down to 25 years. And now your ability to take advantage of the compound curve and all the things that they want to tell you about is gone. All the reasons that this whole buy, hold, accumulate, and invest all your money and take risk when you're young, all that goes out the window. And that's why I say, listen, I just believe that you used a football analogy, I'll do the same thing. The whole idea of the younger you are, the more risk you could take is like the greatest lie in personal finance. I think the younger you are, the less risk you have to take because you have time and compounding on your side. Financial structure and building in the moat, building in the protection around the thing that you're building is more important than ever at a young age. And it's kind of like, I use an analogy with Tom Brady and the Patriots back in the day. They had great offense with Randy Moss and they're throwing the ball down the field. They could throw bombs better than anybody. But when Belichick would start the games with them, what did they do? They scripted out every play. First 15 plays were scripted out, right? Going in, the younger you are, the more risk you can take is the idea of like Tom Brady and Bill Belichick starting the game off just throwing Hail Marys from play one. Why would you do that? You wouldn't do that. You don't need to do that. Like play the game out. Like script your life, build a framework, play the game. You start throwing Hail Marys, I think it should be the older you are and the further away from your goals you are, the more risk you need to take.
Those are the Hail
right?
Marys.
That's when you start throwing Hail Marys.
That's all you got left.
That's all you got, right? And so, like, can you talk, like, what are your thoughts on, like, how do we get people to start realizing one of the most important things that you can do in your 20s and 30s is not try to just chase risk. Not that I'm not saying don't take risk. I'm saying equally as important as taking some risk is making sure that you save money. And you build that staying power. Because if you don't, you will pay the price at some point in time. It's inevitable.
We all have the same compounding curve. It starts when you're born.
Fair
so
enough.
It all just depends. When do I jump on the curve? Is when I actually get the benefit of it. And so when we're younger, we do have the ability we don't have to take maybe the extreme risk because interest over time and the compounding curve does a lot of the work for us, right? We're 55 years old, there's not compounding left before 65. That's gone, right? There's no chance for that compounding curve to work, right? And also when you work with people who are wealthier, they spend way more time protecting than they are taking risk, right? They don't want to start over again. They understand that they don't want to go back from being multimillionaires back to starting over because not only do they not have the time, but they don't want to go through that pain again. So one of the things that's really hard to teach people when they're younger is to get started on that curve because it'll take far fewer dollars, which means you could take less risk because time is going to handle it versus the risk component. Now, everyone can choose what what risk means to them. Is the market risky or making more significant bets on riskier ventures. But the reality is that is the time. Like I think you're actually right, which is I can take smaller bets because I have the time for it to work versus as we get older, we don't have compounding anymore. Like we work with clients who are in their 50s. I have to break the news to them that compounding is gone, right? You're getting back your money's interest, not the compounding effect that you did when the dollars that you put in when you were 20 and 30.
Yeah, man, it's crazy. And so guys, I would say this is my real strong encouragement. Hopefully this video has been inspirational to you to realize like that building that foundational asset into your life so you can have the staying power is one of the most important things you can do. I encourage everybody to look beyond rate of return, look beyond the water cooler conversations where everybody's talking about how much they're earning in their stocks and why would you put money over here because you know, like you're not earning enough and you're an idiot for not, if you're not chasing and getting these 15-20% returns, you're foolish. Life is long, right?
Yeah.
The days are quick, life is long, right? And you're going to hit a time where you're going to need the moat to be there to protect your castle. You're going to be there where you need the foundation of your life to be built on granite, not sand. And that's the most important part. This is why I would say rate of return isn't the most important. The rate of result, like the results that you're after. And then when, as you're building those results, protecting the results that you're after, protecting your progress. One of the things I learned from Garrett Gunderson when I was talking to him was the biggest mistake that people make is they don't take their wins off the table, you know? And when you get there, that's another form of just like galvanizing and performing, and then take some wins off, put it into safe money. Don't go speculate and take big risk with the wins that you just had, because it's kind of like being like, I'm going to the casino, I'm going to play blackjack. You know, it's a 50-50 game basically, you know, and I win and I double and I win and I double and I win 4 or 5 hands in a row. And I'm like, I'm on top of the world, right? And then bang, it's gone. Yeah. Right? Yeah. Because one bad hand. And so that's like, most people are playing personal finances like blackjack, you know, unfortunately. Yeah. But we gotta be doing it from a different perspective.
You'll feel better when you build bigger moats.
Yeah, for sure. Yeah. 100%. And you'll feel more fulfilled and you'll be more empowered, right? I think that's the key. For me, the more success I have and the more I do this, the more empowered I feel to keep expanding in these other areas. The bigger my moat is, the more risk I can take, right? The bigger the protection, the more powerful and strong my foundation is, the more I can go out and try to accomplish.
You can protect against all the marauders when you have a big
exactly.
Moat, right?
All the people I'm pissing off, all the IUL agents I took off, right? So all right, guys. Well, hopefully you found value in this. If you haven't already, make sure you subscribe and hit the bell. That way you're notified every time I launch a video. I'm also going to put a link to in the description down below to Walter's new channel that he's going to be launching, and it's going to be a lot of fun. So I would say go check that out. He's a wealth of knowledge when it comes to this stuff. And that's it for now. If you found value, please share this, like it, get it out there to the world. I think it's important stuff. Until next time, have a blessed, inspirational day. Thanks for being here, man.
It's a lot of fun. Thanks.
Yeah, man.